What if I told you that the greatest investor of all time didn't build his fortune by being the smartest guy in the room, but by following a set of simple, almost boring principles that anyone, yes, anyone, can apply? What if the secret to becoming wealthy wasn't about timing the market, chasing hot stocks, or predicting the next big crash, but about mastering behaviors so ordinary, so timeless, that most people overlook them? Today, we're diving into Warren Buffett Wealth, a book that doesn't just talk about Warren Buffett's money. It reveals how he thinks, why he wins, and what ordinary people can copy starting today. Because here's the truth. Buffett's success isn't magic, it's not luck, and it's definitely not about having millions to start. It's about building a mindset, a philosophy, and a lifelong system designed to create one thing: wealth that compounds steadily, quietly, and inevitably. Think about this for a moment. Buffett bought his first stock at age 11. He filed his first tax return at 13. Today, he's one of the wealthiest humans on earth. Yet he still lives in the same house he bought in 1958 and spends less on breakfast than you spend on Starbucks. Is that frugality? Or is it discipline? Or maybe it's the mindset of someone who understands the long game better than anyone alive. This book breaks down exactly that long game. You'll see how Buffett chooses businesses, not because they're flashy, but because he understands them deeply. You'll learn why he avoids the stock market noise like a plague, and how he focuses on Main Street fundamentals instead of Wall Street hype. You'll discover how he built life-changing wealth not by owning hundreds of stocks, but by betting big on a handful of great companies and holding them through fear, recessions, scandals, and market chaos. But here's where Warren Buffett Wealth becomes more than just an investing book. It's actually a blueprint for thinking, slow, patient, rational thinking, in a world addicted to speed, emotion, and instant gratification. It forces you to ask yourself, what kind of investor am I? Do I really know what I own? Do I have a philosophy, or do I just follow trends? And most importantly, am I building wealth for a lifetime, or just chasing wins for the weekend? By the end of this breakdown, you'll walk away with Buffett's core principles, the same principles that turned a kid from Omaha into an investing legend. You'll also learn the mistakes he made, the myths he shattered, and the life habits that kept him grounded even as billions kept rolling in. So if you've ever wanted to look inside the mind of Warren Buffett, not the billionaire, but the thinker, the learner, the craftsman of wealth, stay with me. Because what you're about to hear might just change the way you invest, the way you work, and the way you build your financial future. Study the best to be the best sets the foundation for the entire book. By explaining why studying Warren Buffett's methods is not an act of idol worship, it's an exercise in learning from a real, proven model of wealth creation. Robert P. Miles opens the chapter with a simple thesis: wealth leaves clues. And Buffett has spent more than half a century leaving a trail that any disciplined learner can follow. The chapter begins by addressing a basic misconception. People often think Buffett is a once-in-a-generation genius, someone whose skills can't be replicated. But Miles argues the opposite. Buffett's approach is built on behaviors that anyone can learn: patience, rational decision-making, understanding one's circle of competence, and applying consistent principles rather than chasing financial fads. Buffett is exceptional not because his methods are secret, but because he actually sticks to them while the rest of the world gets distracted. One of the core messages in Chapter 1 is that Buffett sees investing as a craft, not a gamble. He treats it the way a master carpenter treats wood, with focus, discipline, and respect for long-term results. Miles encourages readers to think of Buffett as a financial mentor whose lessons are available through decades of speeches, letters, interviews, and shareholder meetings. This chapter is essentially a call to action. If you want to build wealth, study someone who has done it at the highest level, over the longest period, with the clearest results. Miles then highlights key pillars of Buffett's philosophy. The first is clarity of thinking. Buffett cuts through noise and ignores complicated financial instruments, sticking closely to businesses he understands. This habit, knowing your limitations, is something the chapter emphasizes repeatedly. You don't need to understand everything. You just need to deeply understand the few things you choose to invest in. The second pillar is focus on quality businesses, not stock prices. Buffett thinks like a business owner, not a stock trader. Chapter 1 explains that investors should evaluate companies based on fundamentals, management quality, competitive advantages, financial strength, not daily price movements. This mindset separates wealth builders from speculators. Another critical lesson introduced is long-term orientation. Miles points out that Buffett rejects short-term thinking entirely. He avoids market predictions, ignores noise, and never acts out of panic. Instead, he commits to long-duration ownership of superior companies, allowing compounding to do its work. The chapter stresses that mastering this mindset is essential for anyone who wants sustainable wealth. Miles also examines Buffett's personal qualities: humility, integrity, discipline, and argues that character is a financial asset. Buffett's honesty and transparency attract talented managers, loyal shareholders, and high-quality deal flow. Wealth is not just the outcome of good investments. It's also the outcome of how you behave and how you treat people. A major takeaway from Chapter 1 is that Buffett's success is teachable because it is behavioral, not intellectual. Most investors know what they should do, but fail to control emotions and impulses. Buffett wins because he has mastered himself. By studying him, readers can learn not only financial techniques, but also psychological habits that prevent destructive mistakes. Miles ends the chapter with an invitation. If you wanted to build wealth, commit to a long-term study of Buffett's methods, not blindly copying trades, but understanding principles, the same principles that guided him from a young investor to one of the most successful wealth creators in history. Chapter 2 lays out a chronological roadmap of Warren Buffett's financial life, showing how his wealth did not come from one big breakthrough, but from a lifelong sequence of deliberate decisions, habits, and capital-building milestones. The purpose of this chapter is simple: to demonstrate that Buffett's fortune is the result of decades of compounding, not overnight success. Robert P. Miles uses Buffett's timeline to teach readers how wealth is built slowly, methodically, and intentionally. The chapter begins by focusing on Buffett's early curiosity about money. At age 6, he sold soda bottles for profit. At 11, he bought his first stock. At 13, he filed his first tax return. Miles emphasizes that these early actions weren't random. They showed a mindset forming long before Buffett became an investor. The habit of thinking in terms of profit, leverage, and opportunity. The chapter argues that wealthy people start training their brains for financial thinking early, even if the amounts are small. Moving into Buffett's teenage years, the chapter highlights his willingness to experiment. He ran paper routes, bought pinball machines with a friend, and turned them into a mini vending business. These experiences built Buffett's understanding of cash flow, customer behavior, and reinvestment. Miles stresses that Buffett was learning principles, not chasing money, principles that later shaped his investment philosophy. By the time Buffett reached college, he had already saved thousands of dollars. The chapter shows that this wasn't luck. It was the accumulation of consistent habits, living below his means, reinvesting profits, and focusing on predictable returns. When Buffett studied under Benjamin Graham at Columbia Business School, the chapter describes it as a major turning point. Here, he learned the concepts of value investing, intrinsic value, and margin of safety, ideas that became the base structure of his lifelong approach. After college, Buffett worked at Graham Newman, where he sharpened his analytical discipline. The chapter shows how Buffett didn't simply copy Graham. He evolved from pure quantitative value investing into a more qualitative approach. This shift later became one of his biggest competitive advantages. The timeline then moves into the creation of Buffett Partnership in the 1950s. Miles explains how Buffett used a simple but powerful fee structure. He only earned money when his partners made money. This alignment of incentives reinforced discipline and trust. Through this partnership, Buffett accumulated capital rapidly, outperforming the market year after year. The chapter emphasizes that these gains weren't from high-risk bets, but from focusing on undervalued, understandable businesses. By the mid-1960s, Buffett dissolved his partnership and took control of Berkshire Hathaway. This moment marks the strategic pivot that defined the rest of his career, shifting from stock picker to business owner. Miles notes that this pivot is crucial for readers to understand. Buffett moved from trading stocks to owning businesses that generated long-term cash flows. The timeline shows how this shift positioned him to benefit enormously from compounding through subsidiaries like Geico, See's Candies, and later Coca-Cola. As the timeline approaches the modern era, the chapter highlights a powerful insight. Buffett became a billionaire, not because he found better investments later in life, but because time finally amplified the compounding process he started as a child. Most of Buffett's net worth was built after age 60, demonstrating that compounding becomes explosive only after decades of consistency. The chapter closes with one overarching message: Buffett's wealth is a product of time, discipline, and a long-term framework. His timeline is not just a biography, it is a blueprint. Anyone who studies these stages carefully can understand how wealth is built step by step, year after year, without shortcuts. Chapter 3 focuses on one of the most important ideas in Warren Buffett's philosophy. Investors must understand who they are before deciding how they invest. According to Robert P. Miles, most people fail in the markets not because they lack intelligence, but because they operate without self-awareness. Buffett succeeds because he knows his temperament, his strengths, his limitations, and the style of investing that fits his personality. The chapter starts by making a crucial distinction between three types of investors. The passive investor, someone who prefers not to actively analyze businesses or manage portfolios. The active investor, someone willing to research businesses, read financial statements, evaluate management, and make informed decisions. The business owner investor, someone who invests with the mindset of owning a company for the long term, focusing on operations and competitive advantages rather than short-term stock movements. Miles explains that Buffett's method sits firmly in the third category. Buffett does not think like a trader or a speculator. He treats every investment as if he were buying the entire business, even when he is only buying a share. This mindset shapes everything from his patience to his valuation methods. To help readers self-identify, the chapter lays out the behavioral traits required for each investor type. Passive investors need emotional detachment and the ability to stick with broad market strategies. Like index investing, active investors require discipline, analytical skill, and independence of thought. Business owner investors need long-term vision, deep understanding of industries, and comfort with holding concentrated positions. One of the chapter's key messages is that most people think they are active investors, but behave like speculators. They react to news, chase trends, jump in and out of positions, and allow emotion to override reason. Buffett avoids this trap by maintaining a clear, well-defined identity as a business-focused investor. He does not change his style based on market conditions. Miles also emphasizes Buffett's belief that not everyone should try to pick stocks. Buffett has repeatedly said that people without the time or interest to evaluate businesses should simply buy index funds. Chapter 3 uses this point to reinforce that self-awareness protects investors from costly mistakes. A passive approach is not inferior. It is suitable for millions of people. What is dangerous is pretending to be an expert while making uninformed decisions. The chapter then moves into Buffett's use of the circle of competence concept. Every investor has areas they understand well and areas where they are blind. Buffett only invests inside his circle of competence, industries he can explain clearly, and businesses he can evaluate accurately. Chapter 3 argues that this discipline allows him to avoid complexity, reduce uncertainty, and make sound long-term decisions. Miles encourages readers to identify their own circle of competence and stay within it, rather than stretching into unfamiliar sectors. Another major theme is emotional temperament. Buffett often says that successful investing is not about IQ. It is about controlling emotions like fear, greed, impatience, and envy. Chapter 3 makes it clear that investors must evaluate not only their financial knowledge, but also their emotional profile. Can you hold a stock when the market is down 30%? Can you ignore media noise? Can you stay rational when others panic? These questions help define what kind of investor you truly are. The chapter ends by summarizing Buffett's advice. Know your investor type. Know your circle of competence. Know your temperament. Then design an investment strategy aligned with those realities. Miles emphasizes that this alignment is the foundation of Buffett's long-term success. Investors who misalign, choosing a strategy that conflicts with their personality or skills, will struggle regardless of market conditions. Chapter 4 centers on one foundational idea. Every successful investor operates from a clear, consistent, and repeatable investment philosophy. Robert P. Miles explains that Warren Buffett's results are not the consequence of random decisions or market predictions. They come from a simple but powerful philosophy he has refined for decades. This chapter breaks down how Buffett built that philosophy and how individual investors can build their own. Miles begins by pointing out that most investors don't have an investment philosophy at all. They react to headlines, follow tips, jump between strategies, and rely on emotion instead of principles. Buffett, on the other hand, has invested for more than half a century using the same core ideas he learned from Benjamin Graham. Chapter 4 stresses that consistency is the competitive advantage. A philosophy gives an investor a framework to act rationally in both calm and chaotic markets. The chapter explains that Buffett's investment philosophy rests on several pillars. The first is value investing, buying businesses at prices below their intrinsic value. Miles clarifies that intrinsic value is not a formula, but a disciplined attempt to calculate the present value of future cash flows. Buffett's goal is simple: pay less than what the business is truly worth, then hold it long enough for the market to recognize its value. The second pillar is economic understanding. Buffett only invests in companies with durable competitive advantages, predictable earnings, and strong management. Miles emphasizes that Buffett's philosophy forces him to filter aggressively. He ignores most opportunities and focuses on a small number he understands deeply. This discipline keeps him away from complexity, speculative sectors, and ventures he cannot evaluate. Another component of Buffett's philosophy is patience. Chapter 4 highlights that Buffett's strategy works because he allows time and compounding to do the heavy lifting. His philosophy assumes that wealth grows slowly and that long-term ownership is more powerful than rapid trading. Miles explains that Buffett doesn't aim for quick profits. He aims for businesses that can generate cash year after year, decade after decade. The chapter also covers the role of risk management in Buffett's philosophy. Buffett defines risk not as volatility, but as the possibility of permanent capital loss. This mindset guides him to avoid high-debt companies, unpredictable industries, and businesses with fragile economics. Miles argues that this conservative approach is a key reason Buffett has avoided catastrophic losses, the kinds of losses that derail most investors. Importantly, Chapter 4 also examines how Buffett's philosophy evolved over time. Initially grounded in Graham-style bargain hunting, Buffett shifted toward buying high-quality companies at fair prices. Once he partnered with Charlie Munger, Miles uses this evolution to illustrate an essential lesson. An investment philosophy should be stable but not rigid. Investors must refine their philosophy as they gain experience, access better information, and understand their own strengths. The chapter transitions into practical guidance. Miles encourages readers to write down their own investment philosophy, a clear set of rules, beliefs, and criteria that guide decision-making. This includes defining investment goals, determining risk tolerance, identifying industries one understands, and choosing a valuation framework. The point is to reduce guesswork and increase intentionality. A major takeaway is that an investment philosophy is not about copying Buffett's decisions. It's about adopting his principles and adapting them to your own abilities. Buffett's philosophy works because it aligns with his temperament, intelligence, and time horizon. Chapter 4 urges investors to develop a philosophy that matches their own reality. Whether they are passive index investors, active stock pickers, or business owner-style investors. The chapter concludes by reiterating that a strong investment philosophy acts as an anchor. It protects investors from emotional reactions, market noise, and inconsistent decision-making. Buffett's extraordinary results come from decades of applying the same philosophy. Through bull markets, recessions, crashes, and global uncertainty, the message is clear: philosophy drives behavior, and behavior drives outcomes. Chapter 5 reinforces one of Warren Buffett's most essential investing principles. An investor must fully understand what they own, not vaguely, not partially, but completely. Robert P. Miles uses this chapter to dismantle the common habit of buying stocks without understanding the underlying business. Buffett views that behavior as speculation, not investing. The chapter opens by stating a simple truth. Most investors know the stock symbol, the price, and the hype, but not the economics of the business behind it. Buffett insists that ownership of a stock is ownership of a real company. When you buy shares, you are buying a slice of its assets, its management, its cash flows, and its long-term future. Chapter 5 argues that this understanding is the foundation of rational investing. Miles explains that Buffett's approach starts with deep familiarity. He does not invest in companies he cannot describe in plain English. If a business is too complicated, Buffett simply passes. This ties directly to the circle of competence discussed in earlier chapters. Knowing what you own means staying within industries where you have genuine insight. Buffett prefers simple business models, insurance, consumer goods, banking, manufacturing, because he can evaluate them confidently. The chapter then outlines the key elements Buffett analyzes before buying a company. The first element is the business model, how the company makes money, how predictable the cash flows are, and whether the economics can sustain long-term profitability. The second element is management quality. Buffett looks for leaders who are honest, rational, shareholder-oriented, and skilled at allocating capital. He avoids companies with executives who chase growth for ego or use aggressive accounting. Another element Buffett evaluates is competitive advantage, or what he famously calls a moat. Miles explains that Buffett only buys businesses with durable moats, brand strength, pricing power, network effects, cost advantages, or regulatory barriers. This ensures the company can endure competition and still generate strong returns years into the future. Chapter 5 stresses that Buffett's emphasis on deep understanding is not merely philosophical. It directly influences his behavior during market volatility. When the stock market drops, most investors panic because they don't truly understand what they own. Buffett remains calm because he evaluates performance based on business fundamentals, not price movements. His clarity reduces anxiety and prevents emotional decision-making. Miles uses several Berkshire Hathaway examples to illustrate the point. Buffett invests in companies like See's Candies and Coca-Cola because he understands their core economics, simple products, loyal customers, strong brands, and reliable long-term demand. These businesses are easy to analyze, easy to value, and easy to own through fluctuating markets. Buffett avoids technology he cannot evaluate or industries based on unpredictable innovation cycles. The chapter also addresses a common misconception. Knowing what you own does not mean memorizing every detail. Instead, it means understanding the drivers of value. What makes the business win? What economic conditions support growth? What threats could destroy it? Investors should focus on the handful of variables that truly determine long-term performance. Miles emphasizes that this level of understanding requires discipline. You must read annual reports, study financial statements, analyze competitors, and track long-term trends. Buffett reads constantly, thousands of pages a week, because information is the foundation of conviction. Investors who fail to do this work will default to emotional reactions, trade frequently, and suffer inconsistent results. The chapter concludes with a direct message: ignorance is expensive. If you cannot explain why you own a stock, you should not own it. Wealth is built when investors buy understandable businesses at reasonable prices and allow compounding to work over time. Knowing what you own creates confidence, stability, and patience, three traits that define Buffett's entire investment career. Chapter 6 clarifies one of Warren Buffett's most misunderstood beliefs: real wealth is created by investing in real businesses, not by engaging in Wall Street speculation. Robert P. Miles uses this chapter to draw a sharp line between Main Street, where businesses operate and generate cash flow, and Wall Street, where prices fluctuate based on sentiment, narratives, and short-term trading behavior. Buffett consistently aligns himself with Main Street and ignores the noise of the financial markets. The chapter opens by defining the difference. Main Street investing focuses on understanding how a company earns money, serves customers, allocates capital, and builds long-term competitive advantage. Wall Street behavior, on the other hand, is driven by price movement, quarterly earnings surprises, analyst opinions, and trends. Miles emphasizes that Buffett treats the stock market simply as a platform to buy pieces of real businesses, nothing more. He does not view stocks as tickers but as ownership stakes. Miles explains that Buffett's long-term success comes from grounding every decision in economic reality. When evaluating a company, he studies its products, its cost structure, its management team, its competition, and the durability of its advantages. This Main Street approach gives him clarity and prevents him from reacting emotionally to market fluctuations. In contrast, investors who operate with a Wall Street mindset rely on predictions, charts, and news cycles, which often lead to fear-driven or hype-driven decisions. A key theme in Chapter 6 is Buffett's belief that the market is not a guide but a tool. The famous analogy appears again: in the short run, the market is a voting machine; in the long run, it is a weighing machine. Miles uses this to stress that Buffett does not care who is voting for a stock today. He only cares about what the business will weigh in 10 or 20 years, its cash flows, profitability, and competitive strength. The chapter then highlights Buffett's preference for companies with predictable business models. Main Street investing demands stability and visibility. That's why Buffett favors industries like insurance, consumer goods, regulated utilities, and financial services, sectors with steady demand and clear economics. Miles points out that Buffett avoids high-volatility industries such as tech startups or biotech because they depend on unpredictable innovation cycles, making long-term analysis harder. Another major insight from Chapter 6 is the importance of ignoring Wall Street noise. Buffett does not rely on analysts, ratings, or market forecasts. He avoids short-term speculation and refuses to trade based on rumors or macro predictions. Miles stresses that this discipline protects Buffett from the emotional traps that dominate Wall Street: fear, greed, envy, and impatience. By focusing on Main Street fundamentals, Buffett can hold investments through downturns without losing conviction. The chapter also highlights how Buffett evaluates capital allocation. Successful Main Street businesses reinvest earnings wisely, expand opportunities pragmatically, and generate increasing returns over time. Buffett studies how management uses retained earnings because reinvestment quality often determines long-term shareholder value. Poor capital allocation, acquisitions for ego, excessive leverage, or financial engineering is a red flag. Miles further explains how Buffett's Main Street approach influences position sizing. Buffett often takes large, concentrated stakes in high-quality businesses because he understands them deeply and trusts their economics. Wall Street thinking promotes diversification across dozens of positions. Buffett argues that true conviction requires investing meaningfully in the few businesses you fully understand. Chapter 6 also stresses the importance of long-term alignment. Wall Street focuses on the next quarter. Main Street focuses on the next decade. Buffett chooses the latter because long-term business performance eventually dictates shareholder returns. Investors who obsess over short-term price action are essentially gambling, while those who study business fundamentals build enduring wealth. The chapter concludes with a simple but powerful message: to invest like Buffett, you must think like a business owner, not a trader. Forget the noise of Wall Street. Focus on real companies, real cash flows, and real economics. When you invest in Main Street, the market eventually rewards you, even if it takes years. Chapter 7 explains one of Warren Buffett's most distinctive investment principles: long-term ownership and concentrated investing. Robert P. Miles uses this chapter to clarify why Buffett prefers to buy a small number of exceptional businesses and hold them for decades, rather than trade frequently or diversify broadly across many companies. This mindset is central to Buffett's compounding success and separates him from typical Wall Street behavior. The chapter begins by challenging the conventional idea that investors should own dozens or even hundreds of stocks to reduce risk. Buffett believes the opposite. Diversification is protection against ignorance. If you thoroughly understand a business, you do not need excessive diversification. Instead, you concentrate your capital in a few high-quality companies, because those are the companies most capable of delivering superior long-term returns. Miles explains that when Buffett buys, he buys with the intention of holding indefinitely. This philosophy reflects both conviction and discipline. Buffett is not looking for quick appreciation or short-term catalysts. He is looking for businesses with durable competitive advantages, stable earnings power, and trustworthy management businesses that make it rational to stay invested for decades. A major theme of Chapter 7 is the power of compounding within long-term ownership. Buffett understands that extraordinary returns come from letting a great business reinvest its own profits year after year. Frequent buying and selling interrupts compounding, triggers taxes, increases transaction costs, and injects emotion into decision-making. By committing to long-term ownership, Buffett minimizes friction and maximizes compounding efficiency. The chapter also highlights why Buffett buys a lot of a few. Concentration only works when the investor has deep knowledge of the business. This is why Chapter 7 ties directly to earlier principles, knowing what you own, investing within your circle of competence, and evaluating long-term economics. If these elements are in place, concentration becomes a rational strategy rather than a gamble. Miles notes that Buffett's large positions in companies like Coca-Cola, American Express, and Geico were not accidents. They were deliberate commitments to businesses he understood deeply and believed would produce consistent value over decades. These concentrated bets, combined with long-term patience, contributed massively to Berkshire Hathaway's growth. Chapter 7 also stresses that holding for the long term requires emotional strength. Wall Street investors often react to noise, corrections, and temporary setbacks. Buffett does not. His decision to hold is grounded in business performance, not price movement. If the fundamentals remain strong, Buffett stays invested even when the market temporarily punishes the stock. This mindset helps him avoid panic selling and take advantage of opportunities when others are fearful. Miles reinforces that Buffett's approach demands conviction rooted in analysis, not hope. Long-term ownership works only when the investor has accurately assessed the company's economic moat, management competence, financial health, and long-term prospects. Without rigorous analysis, buy and hold becomes dangerous. With rigorous analysis, it becomes a powerful strategy. Chapter 7 also addresses the psychological advantage of owning fewer companies. Focus. Buffett can closely study and monitor each business because he owns a limited number of them. This focus allows him to identify risks early, understand capital allocation decisions, and maintain clarity during market uncertainty. In contrast, investors with dozens of positions often lack meaningful insight into any single company. The chapter concludes by summarizing the two-part philosophy. Buy to keep. Treat every investment as if you were buying the entire business, planning to own it for life. Buy a lot of a few. Concentrate capital in the best opportunities, not the average ones. Miles emphasizes that this principle is not about recklessness. It is about disciplined selection and long-term alignment. Buffett's success demonstrates that wealth is built not from owning many mediocre companies, but from owning a few outstanding ones for a very long time. Chapter 8 focuses on an often overlooked aspect of Warren Buffett's success: his willingness to analyze, admit, and learn from his own investment mistakes. Robert P. Miles emphasizes that Buffett's track record is extraordinary not because he avoided errors, but because he understood them, documented them, and adjusted his behavior accordingly. This chapter provides a technical breakdown of Buffett's most common mistake categories and the lessons investors can apply. Miles opens the chapter with a key theme. Even the world's greatest investor makes errors in judgment, timing, and temperament, but he rarely repeats them. In Buffett's view, mistakes are tuition fees for investing education. Chapter 8 argues that most investors lose money not because they make mistakes, but because they fail to learn from them. The chapter categorizes Buffett's mistakes into several types. The first category is buying poor businesses at attractive prices. Early in his career, under Benjamin Graham's influence, Buffett purchased cigar-but companies' businesses with weak economics that appeared cheap. While some produced short-term gains, many deteriorated over time. Miles explains that these experiences eventually pushed Buffett toward higher-quality companies with enduring competitive advantages. The lesson: a great business at a fair price beats a bad business at any price. Another mistake category is investing outside the circle of competence. Buffett has openly admitted that investments in industries he did not fully understand, such as early textile manufacturing and certain retail ventures, resulted in weak outcomes. Chapter 8 highlights that Buffett learned to avoid sectors where predicting long-term economics is too difficult. This reinforces the principle that investors should remain disciplined about staying within areas they can evaluate with confidence. Miles also discusses mistakes involving management quality. Buffett has acknowledged that he occasionally trusted CEOs who turned out to be poor capital allocators or lacked integrity. These experiences shaped his stringent criteria for management: honesty, rationality, and shareholder alignment. Chapter 8 stresses that Buffett now evaluates management with the same rigor as financial metrics, because poor leadership can destroy business value even when economics look strong. A significant portion of the chapter analyzes mistakes of omission, opportunities Buffett recognized but failed to act on. He has stated multiple times that these missed opportunities cost significantly, more than his bad investments. For example, he admired companies like Walmart long before he bought them, yet hesitated due to valuation concerns or timing uncertainty. Miles explains that Buffett views omissions as errors in discipline or conviction, not merely missed profits. The takeaway: hesitation can be as costly as a bad decision. Chapter 8 also explores mistakes related to timing and reaction to market conditions. While Buffett does not attempt to time markets, he acknowledges moments where emotional bias or external noise temporarily influenced his decisions. Miles uses this to show that Buffett continuously works on controlling temperament, recognizing that psychological errors can undermine analytical reasoning. Another key lesson from this chapter is Buffett's practice of publicly documenting his failures. In Berkshire Hathaway's annual letters, he openly analyzes poor decisions, explaining what went wrong and how he intends to avoid repeating the behavior. Miles highlights this transparency as a competitive advantage. It forces accountability, reinforces disciplined thinking, and improves future decision-making. Chapter 8 ends by distilling the practical lessons investors can apply. Avoid low-quality businesses even if they appear cheap. Stay inside your circle of competence and resist the urge to chase trends. Evaluate management rigorously. Character matters as much as financial performance. Recognize errors of omission and develop the conviction to act. When great opportunities align with your philosophy, make mistakes visible, document them, analyze them, and refine your process. Control your temperament, because emotional errors are often more damaging than analytical ones. Miles concludes that Buffett's true advantage is not perfection, but consistent improvement. His discipline in studying mistakes gives him a compounding edge, not just in capital, but in judgment. Chapter 9 focuses on dismantling the most widespread myths related to Warren Buffett, personal wealth, and investing. Robert P. Miles explains that many people misunderstand Buffett's success because they filter it through false assumptions, oversimplified narratives, and misconceptions pushed by Wall Street culture. This chapter clarifies those myths and replaces them with practical truths that real investors can apply. The chapter opens by addressing the biggest misconception: Buffett is successful because he is a natural-born genius. Miles argues that Buffett's advantage is not extraordinary intelligence, but extraordinary discipline. Buffett himself has insisted that successful investing requires rationality, patience, emotional control, and a long time horizon, qualities that most people can develop, but few consistently apply. The myth of genius-level intuition prevents investors from realizing that Buffett's method is learnable. A second myth is Buffett takes big risks to get big rewards. In reality, he does the opposite. Buffett actively avoids risk, defines risk as the possibility of permanent capital loss, and constructs his portfolio around predictable businesses. Chapter 9 stresses that this myth persists because the public confuses volatility with risk. Buffett only invests where long-term economics are understandable and reliable. His results come from minimizing downside, not maximizing excitement. Another common myth is Buffett times the market. Many observers mistakenly believe he knows when to buy or sell based on macroeconomic foresight. Miles debunks this by explaining that Buffett ignores forecasts, interest rate predictions, and market cycles. His decisions are driven entirely by the price of a business relative to its intrinsic value. Timing plays almost no role. The myth survives because people assume great performance requires predicting the future. Buffett proves otherwise. The chapter then tackles the myth Buffett only buys cheap stocks. This misunderstanding comes from Buffett's early years under Benjamin Graham. Miles clarifies that modern Buffett seeks quality at a reasonable price, not bargains for their own sake. He prefers companies with strong moats, consistent cash flow, and trustworthy management. Chapter 9 emphasizes that Buffett learned the hard way that cheap companies with bad economics rarely create lasting wealth. Another widespread misconception is anyone can copy Buffett by reading his portfolio. Miles explains that cloning Buffett's trades is ineffective because Buffett often buys private businesses unavailable to the public. His time horizon is measured in decades, while most investors think in months. His decisions reflect deep understanding built from reading thousands of pages yearly. His cost basis and tax structure differ substantially from retail investors. The myth that copying positions equals copying success ignores the process behind the positions. The chapter also debunks the belief that Buffett hates technology. Miles clarifies that Buffett avoids industries he cannot evaluate, not technology in general. His investment in Apple demonstrates that once a tech company's economics become predictable, Buffett is willing to act. The myth persists because people mistake selectivity for avoidance. A significant portion of Chapter 9 examines myths about wealth itself. One myth is that wealth comes from high income. Buffett's life shows the opposite. Wealth comes from compounding capital, not earning more salary. Another myth is that wealth requires constant activity, trading, hustling, reacting. Buffett's success shows that wealth often comes from inactivity, buying great assets, and letting them grow. Miles also addresses the myth that investing is complex. Buffett succeeds specifically because he simplifies and ignores unnecessary complexity. He avoids complex financial instruments, confusing narratives, and short-term speculation. The chapter emphasizes that the financial industry benefits from making investing look difficult because complexity increases demand for advisors, products, and trading. Buffett's approach removes that illusion. Chapter 9 concludes with a unifying message: myths distort behavior. When investors believe in myths about genius, timing, risk-taking, complexity, or shortcuts, they behave irrationally and suffer poor results. Buffett's career demonstrates that wealth is built on discipline, understanding, patience, and long-term thinking. By replacing myths with principles, investors can align their behavior with how wealth is actually created. Chapter 10 shifts the focus from Warren Buffett himself to the broader question: what principles will define the next generation of Buffett-like investors? Robert P. Miles distills Buffett's lifelong philosophy into 5 core principles that any disciplined investor can adopt. These principles are not shortcuts. They are behavioral and analytical foundations that shape long-term success. The chapter opens with an important clarification. The next Warren Buffett will not look or operate exactly like Buffett. Rather, this person will embody the same mental models, discipline, temperament, and decision-making framework that define Buffett's approach. Miles explains that the goal is not imitation of tactics, but replication of principles. Principle 1. Think like a business owner, not a stock trader. Miles emphasizes that the next Buffett will evaluate companies the same way. An owner analyzes their own business. This principle rejects trading, speculation, chart patterns, and short-term narratives. Instead, decisions are based on long-term cash flow potential, competitive advantage, and management quality. The chapter reinforces that this mindset leads to clearer analysis, reduces emotional noise, and anchors decisions in economic reality. Investors who adopt this principle naturally develop patience, conviction, and focus, traits that mirror Buffett's behavior. Principle 2. Operate within a strict circle of competence. A defining hallmark of Buffett's success is his ability to stay within what he fully understands. Miles explains that the next Buffett will have a narrow but deep expertise. Rather than diversifying broadly, they will invest heavily in a few areas where they can evaluate long-term economics accurately. This principle is grounded in intellectual honesty. Knowing what you don't know is as important as understanding what you do. Chapter 10 stresses that disciplined ignorance, declining opportunities outside one's circle, is a competitive advantage in a market obsessed with chasing trends. Principle 3. Demand a margin of safety. Miles highlights that great investors protect themselves from uncertainty by insisting on a margin of safety, paying significantly less than a business's intrinsic value. This principle buffers against analytical errors, market volatility, and unforeseen risks. The next Buffett, the chapter explains, will avoid overpriced assets, emotional buying, and narrative-driven valuations. Instead, they will purchase only when the relationship between price and value is favorable enough to absorb mistakes. This patience sets apart disciplined investors from speculators. Principle 4. Focus on high-quality, long-term compounding machines. Miles emphasizes that Buffett's modern success comes from owning exceptional businesses, not cheap ones. The next great investor will apply this same filter, identifying companies with durable competitive advantages, strong returns on capital, predictable earnings, and management that allocates capital intelligently. The chapter makes a key point: wealth is created not by trading often, but by owning a small number of compounding franchises for decades. This principle requires long holding periods and deep conviction. It also minimizes taxes, fees, and emotional errors. Principle 5. Maintain emotional mastery and rational temperament. Chapter 10 argues that temperament is the ultimate differentiator. The next Buffett will not be the smartest analyst, but the calmest decision maker. Emotional discipline, resisting fear, greed, envy, impatience, and social pressure is the trait that most investors lack. Miles explains that Buffett's advantage comes from rational consistency in environments where others behave irrationally. The next Buffett will similarly thrive during market extremes by staying anchored to principles, rather than reacting to noise. Chapter conclusion. Chapter 10 concludes with a strong message. The next Buffett is not defined by tactics, but by character and process. The 5 principles: business owner thinking, circle of competence, margin of safety, focus on compounding machines, and emotional discipline form a durable framework for long-term wealth building. Miles emphasizes that anyone who adopts these principles with consistency and patience positions themselves to achieve far superior results than the average investor. The chapter's purpose is not to elevate Buffett as an unreachable figure, but to demonstrate that his success is rooted in behaviors that can be studied, practiced, and applied. Chapter 11 shifts from investing to a broader concept of wealth. Robert P. Miles explains that Warren Buffett does not define a rich life purely in financial terms. Instead, he views money as a tool, one component of a much larger framework that includes relationships, personal satisfaction, integrity, health, and purpose. This chapter breaks down the principles Buffett uses to create a life that is not only financially successful, but also meaningful and sustainable. The chapter opens by emphasizing that Buffett lives far below his means, not because of frugality for its own sake, but because he aligns spending with genuine personal satisfaction. He does not use wealth to impress others or inflate his identity. Miles points out that Buffett's modest lifestyle, same house since 1958, simple routines, no luxury obsessions, is intentional. It reflects Buffett's belief that financial independence comes from needing little, not from spending much. A core theme of Chapter 11 is the value of time. Buffett structures his life around activities he enjoys: reading, thinking, and allocating capital. He delegates operational tasks, avoids cluttered obligations, and designs his schedule to maximize focus. Miles explains that Buffett's success is partly due to the fact that he protects his time as fiercely as he protects his capital. The lesson: a rich life prioritizes personal freedom over busyness. Relationships form another major pillar. Buffett consistently emphasizes the importance of surrounding yourself with people you admire and trust. Miles explains that Buffett evaluates relationships based on integrity and mutual respect, whether in business partnerships, friendships, or family life. Buffett believes that who you spend time with shapes your thinking, your decisions, and ultimately your outcomes. A rich life requires filtering relationships just as carefully as filtering investments. The chapter also addresses reputation and character, which Buffett considers invaluable assets. He famously says it takes 20 years to build a reputation and 5 minutes to ruin it. Miles highlights that Buffett's ethical consistency has created opportunities, partnerships, and goodwill that money alone cannot buy. This stability allows Buffett to conduct business with minimal legal conflict and maximum trust, creating compounding benefits throughout his life. Buffett's approach to work and passion is another key insight. He encourages people to tap dance to work, meaning they should pursue work that naturally excites them. Miles explains that Buffett's career demonstrates this principle. He has structured his life so that his profession feels like a hobby. This alignment allows him to sustain peak performance over decades without burnout. A rich life, according to Buffett, integrates enjoyment and productivity rather than treating them as separate domains. Chapter 11 also highlights Buffett's lessons on giving and legacy. Buffett believes that massive wealth should benefit society, not distort personal habits or burden children. His decision to give away nearly all his wealth stems from a belief that money has its highest usefulness when allocated to those who can deploy it effectively. Miles notes that Buffett separates wealth creation from wealth distribution. The first requires personal discipline, the second requires public responsibility. Another foundational idea in this chapter is emotional well-being. Buffett avoids environments filled with anger, envy, and drama because these emotions reduce rationality and lower quality of life. Miles explains that Buffett intentionally designs his mental environment to be optimistic, calm, and focused. A rich life is partly the result of managing one's emotional inputs, the same way one manages an investment portfolio. The chapter concludes by connecting these non-financial lessons back to Buffett's investment philosophy. The same traits that make Buffett successful, patience, discipline, rationality, focus, and integrity, are also the traits that produce a fulfilling life. Miles emphasizes that Buffett is not simply wealthy because he invests well. He invests well because his life is built on systems that support long-term thinking and emotional clarity. Chapter 12 serves as the conclusion of Warren Buffett Wealth, tying together the principles, behaviors, and philosophies that have shaped Warren Buffett's long-term rise into one of the most successful wealth builders in history. Robert P. Miles uses this chapter to emphasize that Buffett's life is not a story of shortcuts or hidden secrets. It is a lifelong journey defined by consistency, curiosity, discipline, and compounding. The chapter begins by framing Buffett's career as a lifetime compounding exercise. Miles explains that Buffett is the ultimate example of what happens when rational decision-making is applied over a very long time horizon. His results are not the product of a singular moment of brilliance. They emerge from decades of practicing the same principles with almost mechanical reliability. The chapter urges readers to view Buffett's career as a timeline of steady progress, rather than sudden transformation. A central theme in Chapter 12 is the importance of continuous learning. Buffett spends the majority of his day reading, analyzing, and thinking. Miles emphasizes that Buffett's intellectual curiosity forms the backbone of his investment success. He consistently expands his understanding of industries, business models, and human behavior. The chapter explains that the journey of wealth building requires constant knowledge accumulation, not sporadic bursts of effort, but daily habits that compound just like capital. Another key insight is Buffett's practice of incremental improvement. Miles notes that Buffett rarely makes dramatic changes. Instead, he refines his framework little by little, incorporating new insights while discarding ineffective habits. This is how Buffett evolved from Graham-style bargain hunting to Munger-influenced quality investing. Chapter 12 stresses that investors should embrace evolution instead of rigidity, learn, adjust, and optimize over time. The chapter also emphasizes that Buffett's journey is grounded in clarity of purpose. He focuses only on activities that align with his strengths, capital allocation, business evaluation, and long-term thinking. Miles explains that Buffett intentionally avoids areas outside his skill set. He does not run Berkshire's operating companies. He does not manage people directly. He does not chase trends. This focus allows him to operate at a high level for decades. The lesson: a lifetime of success requires alignment between what you do and what you are built to do. Chapter 12 expands on the idea that Buffett's journey is supported by disciplined temperament. Miles highlights that Buffett's emotional stability has protected him during market crashes, investor panic, and economic uncertainty. He stays rational when others are fearful, patient when others are impatient, and confident when others doubt long-term fundamentals. This temperament compounds as powerfully as capital. Each cycle of emotional discipline reinforces long-term performance. Miles also emphasizes the importance of relationships in Buffett's journey. Partnerships with people like Charlie Munger, Bill Gates, and key Berkshire managers have shaped decisions, improved investment frameworks, and strengthened culture. Chapter 12 underscores that Buffett's journey is collaborative. He builds long-term relationships based on trust, integrity, and shared philosophy. These relationships amplify his strengths and minimize his weaknesses. The chapter transitions into Buffett's philosophy on legacy and stewardship. Buffett believes that wealth should be responsibly deployed. His commitment to returning nearly all his net worth to philanthropy reflects his belief that capital is most valuable when it serves society, not when it inflates personal lifestyle. Miles highlights that Buffett views wealth not as an end state, but as a resource with responsibilities attached. Chapter 12 concludes by reinforcing that Buffett's journey is replicable in principle, not in detail. Investors cannot copy his exact investments or circumstances, but they can copy his behaviors, rationality, patience, continuous learning, disciplined decision-making, and long-term thinking. Miles closes by reminding readers that the ultimate lesson from Buffett's life is that anyone can build significant financial and personal wealth through simple principles applied consistently over a lifetime. Warren Buffett Wealth distills more than 5 decades of Warren Buffett's thinking into a practical framework that any disciplined individual can apply. Robert P. Miles structures the book around the behaviors, mental models, and long-term philosophies that have allowed Buffett to become not only one of the richest people on the planet, but one of the most consistent and rational investors in history. The book begins by setting the foundation. Wealth leaves clues, and Buffett's career is a blueprint filled with teachable lessons. From his early childhood ventures to building Berkshire Hathaway into a compounding machine, Buffett's journey demonstrates that sustained success comes from rationality, patience, and consistent application of a simple philosophy. Central to the book is the idea that investing is a behavior-driven discipline, not an intelligence competition. Buffett wins by controlling emotions, staying within his circle of competence, and treating stocks as ownership stakes in real businesses. He avoids market noise, ignores predictions, and evaluates companies based on fundamentals, cash flows, competitive advantages, and management integrity. Miles highlights that Buffett's approach is grounded in long-term business ownership, not stock speculation. Buffett concentrates his capital in a few exceptional companies, holds them for decades, and allows compounding to amplify results. He rejects high-risk behavior, over-diversification, and trend chasing. Instead, he focuses on durable moats, predictable economics, and rational capital allocation. A major theme throughout the book is learning from mistakes. Buffett openly documents his errors buying weak businesses, trusting poor managers, or hesitating on high-quality opportunities. His advantage is not perfection, but continuous improvement. The book stresses that investors who analyze mistakes improve their decision-making compounding. Just as capital compounds, beyond investing, Miles provides insight into Buffett's philosophy on living a rich life. Wealth is not measured by luxury or consumption, but by freedom, meaningful relationships, reputation, and alignment between work and passion. Buffett protects his time, works on what he enjoys, surrounds himself with people he admires, and prioritizes integrity as a core asset. The final message of the book is clear. Buffett's results are exceptional, but his principles are accessible. You cannot copy his investments, but you can copy his mindset. Long-term thinking, rational behavior, disciplined learning, selective investing, and emotional control are available to anyone. The Buffett model is not about genius. It's about consistency. If this breakdown helped you understand Buffett's formula for building lifetime wealth, make sure you hit the like button, because it tells YouTube this is content worth sharing. And if you're serious about improving your financial thinking, not chasing hype, not gambling, but actually building long-term wealth, then subscribe to the channel. We publish deep dive book summaries, wealth building frameworks, and practical financial insights every week. Drop a comment below and tell me, which Buffett principle do you want to apply first? Your answer helps shape future videos. And as always, think long-term, stay rational, build wealth the Buffett way.